You're listening to the Stock Detective Podcast. I'm Kermit Capital. On this episode, we'll be interviewing Chris Seifel from Seifel Capital. Chris joined FinTwit in June and quickly gained a large following with his deep dives on high-growth tech companies like Snowflake, Fastly, and CrowdStrike, posted on his Substack, seifelcapital.substack.com. In this interview, Chris shares a detailed breakdown of his investing process and makes a compelling case for investing in some of these companies. But before we get into the interview, here's a quick disclaimer. This podcast does not constitute an offer of or solicitation for purchases or sale of securities or provision of any investment services. It is provided for information only and should not be considered as investment advice or a recommendation to buy, sell, or hold a particular investment. You are responsible for your own investing decisions. You're listening to the Stock Detective Podcast. I'm your host, Kermit Capital, and I'm joined by my co-host, Deval Kotecha. And today we have a special guest, Christopher Seifel. Chris Seifel, Twitter handle @Seifel Capital and founder of the Seifel Capital newsletter, states he's on a mission to provide readers with the best investment analysis and framework available to the public. His goal is not to tell you what to think about companies and markets, but how to think about companies and markets. Chris, thanks for joining us today.
It's my pleasure. Thanks for having me. This is quite a treat. I'm excited.
Awesome. We got an awesome slide deck to go through. So our first question is, what led you to where you are now, and what got you interested in investing?
Sure. So really quickly, I grew up outside of Boston, Massachusetts. I was always pretty good with numbers, loved math, very competitive. I played sports. And I remember getting very interested and fell in love with the markets at an early age, sitting next to my dad, looking at the newspaper, and picking out all of the stocks that had the highest stock prices and thought I was the best investor of all time. I've learned a little bit since then, which is good. But after that, I went to a private high school in central Massachusetts, ended up going to the University of Miami, was going to play baseball there. That fell apart, so I wanted to be a sports agent. But then I had an internship, got introduced to the stock market, and just fell in love. Ended up graduating summa cum laude with a double major in finance and economics. I went down the banking path, and then I was trying to decide whether I go straight to public markets or another different path that could maybe enhance my skill set. And I had a great mentor that recommended that I go down the private equity route first, because I'd be able to hone and develop my fundamental analysis skill set, which is really what I wanted to do. I wanted to be able to analyze companies from the ground up, and private equity was apparently, and I confirmed, the best way to do that. So I did that for the past 4 years. And in April of this year, I actually left the private equity space. And in about Q3, I think it was, I started publishing my own public markets research. And right now I'm just in the process of looking for a full-time job, either at a hedge fund or another public market investment manager. But, what I do know is that my passion's in public markets. I absolutely love it. I wake up every day beyond excited to do what I do. And, I hope that my readers, followers, whoever may be, really get a lot out of my work product, because it's what I'm passionate about. It's what I love to do. And just looking forward to doing it for the rest of my career.
Excellent. Yeah, I found you through Twitter, and I have been following through your Substack newsletter, and I can say you do a great job. And so coming back to the investing, I would be curious if you can talk about your investing process, and if you can describe your investing style and your framework.
Sure. So in the interest of time, since we only have, I think, about an hour for the show, because I could ramble on about my framework, my style, process, everything for maybe an entire day. So just at a high level, I actually have an Excel file that has a very long, drawn out process, almost like a checklist, that I usually follow. Now, I don't have the time to necessarily do that for every company on a weekly basis, but I at least capture the high level things. So starting from maybe a high level framework, right? I was trained as a value investor, I think, through school. I think like a lot of us, right? Growing up, learning about Ben Graham, Warren Buffett, et cetera. And I've taken a lot of those same skill sets and apply that to what I do now in more of what we call the growth space. Now, Warren Buffett argues that there's really no difference, right? Because at the end of the day, we're trying to find companies that are currently valued by the market less than what we believe their true value is. So I think growth and value is more of a distinction without a difference. With that aside, I run personally a concentrated portfolio because I believe that if you're going to invest in individual securities, you do need to know your companies inside and out. And I can't do that with more than 6 to 8 names. Maybe 10 would be appropriate given the amount of capital I have. But that's why I invest in ETFs through my 401k, because I don't have time to do any more than that. So that's kind of how I manage and construct my portfolio. What I do is I want to own the best companies in the best industries, because if you look historically, there's about a 75% correlation between industry's performance and the stock's performance. Additionally, I do know that opportunity cost is real. So the way that I view my portfolio is I'll look at every single day, every week, whatever it may be. I'll think, are these the best companies I should be invested in? I don't care what my cost basis is. I don't care how much I've earned on these companies, what my return is. I want to make sure that my capital is allocated efficiently to the highest reward to risk ratio companies. Now, I do believe that returns are all about slugging percentage and not batting average, for those of you baseball fans out there. I'm going to be wrong a lot. I think that if you've been following me on Twitter for a while, I actually posted something on Alteryx, and Alteryx proceeded to fall from, I think it was like 170 down to about the 100s. So I'll be wrong. So the trick is to minimize that left tail and cut my losses early and then let my winners run. And that's really how I think about managing my portfolio itself. And then my buy decisions are a combination of mostly my fundamental analysis, about 70%, 80% or so. And then technical analysis I use to time my entry points. So once again, high reward to risk ratios based off of empirical evidence trailing back over 100 years. And then my sell decisions are really all technical based. Now, sometimes a story could change for a company, but I want to be offensive in my sell rules by capturing high returns, and that will mostly be technical based. Now, I can go through quickly a high level of what my process is in more detail if you guys want.
Yeah.
Sure. Okay. So I always start with, a screen, right? So what kind of companies do I look for? I want to find high growing companies in, once again, great industries. And what I'll do is I'll look through sources like Twitter. I'll read industry blogs. I'll do different things like that to find some cool ideas, while also having a framework for my view of the world. Like, what's happening out there? Where is the world going to? Where is there opportunity? And then finding companies that do that. So then I move on from there to an industry analysis. And what I really want to focus on with my industry analysis is, okay, this is how the industry has traded in the past. And these are the core fundamental factors that drive this industry, these stocks. And so I want to determine if the forward returns are based off of either 1, changes in multiples, or 2, is it changes in forward estimates. And then what are the fundamental factors that drive those industries, and what is the lag and lead time between those fundamental factors and industry performance? Then I move on to my company analysis. And a lot of that initial research is done really starting off with just going to the company website. What I've found when I talk to investors is a lot of them don't even go to the website, which is a treasure trove of information. Mm-hmm. I really get a good understanding of what a company does just by doing that. Then I'll dive into the proxy statement, the 10Ks, the 10Q, and the conference call transcripts, and really get a holistic understanding of how the company makes money. What is their business model? What is their selling model? What is their pricing model? All these things are really important to me. Then I look at, why do the customers like it? How do they feel when they use the product? What is the value that they receive? Then looking through the proxy statement at management. Do they have substantial ownership in the company? What is their past experience? Are they successful? Are they good capital allocators? And I use metrics for that. And then I also want to understand their competition, certain risk factors, how they solve problems. What is the current dynamic in the industry, and how does the company's solution solve those problems? Those are all the things I really want to look at. And then in terms of my investment, I want to understand what are the 3 to 4 critical factors that drive the company's stock price? And then what are the 3 to 4 catalysts that will drive those critical factors? Because that for me will determine the timing of the investment and my horizon. Once I do that, I then dive into a financial analysis. I build out a fully detailed model, really just for the purpose of trying to understand the drivers of the business and the leverage. Because at the end of the day, none of us can know what a company is going to look like in the next 2, 3, 4, 5 years. I don't even know what my bank statement is going to look like in the next year. So I really want to just understand what are the drivers of the business and directionally where is it going? And then I can use my critical factor assumptions to test, okay, is this undervalued or overvalued versus market expectations? And then from there, I'll do my pre-investment process, which is really based off of a pre-mortem. So I want to understand, okay, if my investment in this company goes completely wrong, I lose all my money, what happened, right? And it's basically inversion, right? I want to think about what are all the wrong things that could happen so I can avoid them, avoid those risks. And then I'll wait for a high reward risk probability entry point, like I talked about. And if it's the stock that I want to invest in and I have that tactical buy point, then I'll invest.
Excellent. That was a great process and a great overview. I can tell that you can go on for a whole day on this.
Of
But
course.
if you can talk about your framework, that would be great.
Sure. No, definitely. So, on the screen, I think everyone can see kind of the main things that I look for and think about when I'm analyzing a company. And I think, it was Snowflake, which I just published my newsletter 2 days ago. It was the first time that I kind of released this out to the public. And what I want everyone to understand is that this is something that's constantly evolving. Even I'm sure Warren Buffett and Charlie Munger and anybody that's invested for a long time, their process constantly evolves. You're always learning. And that's what I love about the public markets. If you're not learning, then I think you're doing something wrong. So let's just run down the list pretty quickly. I want to find a company that has a competitive advantage, a sustainable one. And the way you can think about that is if the return on invested capital is greater than their cost of capital. And that would only result really if the company is a true moat, right? If they can defend against any competitors or any changing industry dynamics. I want companies that have a superior product, right? So I think a lot of investors maybe focus on the financials first and the fundamentals. But at the end of the day, it comes down to a product that customers love and then management's ability to execute on that product and vision. So I want to see then excellent or improving unit economics. And now in the SaaS space, we think about things like the rule of 40 or CAC paybacks or retention. Those are things that I want to see a company really executing on and doing well, not only in a current period, but sustained over a period of time and then a trajectory to continue either improving or maintaining that performance. I want to find companies that have efficient, frictionless go-to-market strategies and land and expand capabilities. Now, what does that allow? That allows a company to essentially grow within its customer base without having to expend additional sales and marketing dollars. So if you think about, as an example, a company that has a dollar-based net retention ratio of 130%, we'll say, all that means is that if the company did nothing else for the next year, it would grow at 30%. That's incredible. That's margin accretive. And I love to see that in my companies. Obviously, superior revenue growth is very important. Top line drives the company. Top line is indicative of the customer's experience and has a high correlation to at least the SaaS space, their stock performance. I want a high quality management team. At the end of the day, you can have a great product, but if you don't have a management team that could execute on that vision, then it's almost pointless. And I do want to see that they're aligned with shareholders, meaning that they have skin in the game, that they do own stock of the company so that I can make sure that their interests are aligned with mine. I love to see pricing power. So no matter what the environment is, the company can withstand inflationary or deflationary environments, no matter what's happening down the supply chain. A way to measure that, this is a Richard Lawrence concept from Overlook Investments. He looks at cash gross margins. And that's something that I look for as well. And it's hard in some of the newer names, but over time, it's something I definitely track. I want recurring revenue. I already talked about dollar-based net retention ratios, and that's the way to measure your recurring revenue. And In the new software, the SaaS-based paradigm, that's how you get recurring revenue versus the old paradigm, which was license fee-based. I want a sticky solution. So what the company does, it hooks its customers in, and the customer doesn't have a reason to leave the platform and actually has a motivation to stay in the platform. And you'll see that the two companies that we're going to talk about, they have that exact characteristic. I want to see innovation. You know, a company can't just build one product and hope that it's one and done. The company needs to have a great team of developers, of architects, whatever it may be, that constantly produce new products that add value to its customers and can allow it to continue to expand within its customer base. I want to have an industry that is growing with a large TAM and expanding runway. At the end of the day, the macro side does matter. TAM can be expanding drastically, and there can be a good amount of competitors in the space. But if TAM is expanding, then everyone can grow, and you won't necessarily have your market share eaten into. I want to own the top one or two companies in an industry. There's just no reason to own an inferior company, I don't think. I want to see strength, I want to see dominance, and that's really what I focus on in terms of competitive positioning. I want to see, once again, rapidly improving metrics and a path to profitability. So there are really two things here, right? I want to see that a company can generate positive operating cash flow or free cash flow. And if they're not, at least there's a path to it, right? Their margins are improving. And the reason for that is twofold. One is they can continue to use their own internally generated cash to invest in the business. And then two, if a company is negative free cash flow or negative operating cash, then there's a possibility that they'll have to issue equity and dilute shareholders. And I do not want to be diluted. So that's something I really focus on as well. Customer diversification, this is more of a risk factor. You know, I don't want to see my top three or four customers of a company consisting of 30 to 40% of the company, because that's just credit risk. On the balance sheet, you know, at a very high level, I want to see a company with a lot of cash and little to no debt. This is, once again, just a credit risk type of thing. And then as well as the company's ability to invest where it wants to and when it needs to. Low CapEx and funding requirements. This also goes back to dilution, as well as the ability to allocate capital to higher returning type of initiatives. And we could get into the accounting side of things and the differences between software names versus your legacy type of companies. I'll leave that to the side for now. But that's also something I look for in terms of having an asset light model, because then you can compound your earnings and your cash flow off of a lower asset base. So it's higher efficiency. And then lastly, what is the customer's view of the company? You know, you can look at net promoter scores, which I find helpful if it's available. And then customer reviews. I don't think a lot of investors look at customer reviews, but it's very critical to how customers view the company, then the company's ability to then retain those customers and grow its customer base even further.
Awesome. This is a great comprehensive framework. And using this framework, we're wondering if you can pick one of your favorite companies that you own and talk through how you use this framework to buy that stock.
Definitely. And guys, let me know if timing is an issue, because I could once again just keep going on about these companies. And you're going to see and if anyone that's followed me on Twitter or read my newsletter, I'm going to talk about CrowdStrike Holdings right now, ticker CRWD. I think that everybody knows, it's no secret that I have a mass affinity for this company. I do think that they are going to be one of the big winners over the next few years. And we can just go through my framework. So first, let's start off, you know, what is CrowdStrike? So CrowdStrike is a security as a service company, cybersecurity. They provide a cloud native endpoint protection solution, which utilizes crowdsourced data and cloud analytics to detect and prevent cyber threats. And so if you think about what's so interesting and great about this concept, is that they're disrupting the industry by leveraging network effects of crowdsourced data. Once again, so what's sticky, right? The more customers that go onto their platform, the more data and data logs the company gets as a whole, and then you can see the behaviors of different malware and different malicious attacks that they can then defend not only that customer's endpoints, but all the endpoints across the ecosystem. That's very valuable. They do this through what they call a graph database, or through a threat graph. The platform that they've developed is called the Falcon platform. It's the first multi-tenant cloud-native intelligence security solution that's capable of protecting workloads across an organization, across virtualized environments and cloud-based or on-prem environments. It's really flexible and dynamic in that way. So at a high level, they're an endpoint protection platform. They provide EDR, which is emergency detection, endpoint detection and response. And they developed 11 different modules so far that allows them to land with as many as one module and then expand within their customer base accordingly. So what they've stated as well is that the first module covers the entire customer acquisition costs, and then everything after that drops right down to the bottom line. So it's a very margin accretive model that they've developed. So they really do three things. It's protection, prevention, and response. And so if we want to just dive right into the framework side of it, let's talk about their competitive advantage or the moat. So first of all, it's a lightweight agent that's just installed on customers' endpoints. So, like your phone, any mobile device, any computer, whatever it may be. And as I mentioned, they utilize crowdsourced data across their entire ecosystem to analyze all data logs in real time, so that if something pops up, if a malicious attack pops up on one customer, it can then respond to that attack on the customer, but then prevent every other endpoint across its entire ecosystem from that type of malicious attack. So that's incredibly useful. It's a network effect that will keep customers in the ecosystem and allow them to grow their customer base rapidly. So they grew, I think it was over 926 new customers last quarter, which was 91% year over year, which is just beyond incredible. So that's their competitive advantage. In terms of the superior product, I mentioned the threat graph, which is their ability to ingest all these data logs and see what is happening in real time. And the key here is that in the legacy models, they used what was called a signature-based antivirus, which was looking at, they knew what the signature was of any malicious or malware attack, and they would just build that into whatever the software was that was installed on the endpoint. What CrowdStrike does, and what these newer security cloud companies are doing, is they're using behavior-based antiviruses, or a next-gen antivirus, which looks at how do these malicious behaviors act. And they can then accordingly, just whenever they sense or see this type of behavior, they can act quickly. So it's the difference between reactive and proactive security. Now, in terms of the excellent and improving unit economics, CrowdStrike has one of the best, I think, unit economics and growth profiles out there. Just thinking high level off some of their margins, I think they did 75% gross margin over the past quarter, which is actually improving. So they actually have some runway there, and that's actually a result of their ability to land and expand once again. And I'll mention kind of the module adoption by customers in a little bit. They're utilizing artificial intelligence and machine learning, which is something that more customers or companies are starting to adopt, but is a huge upgrade over the legacy providers. And then, as you can see by reading the customer reviews, customers just love it. So as in terms of other types of unit economics, their rule of 40, which is how I calculate is their last 12-month growth rates versus the last 12-month free cash flow margin, which measures a company's ability to grow as well as maintain profitability. Their rule of 40 was 115%, which if you look across the SaaS space, it is number 2 to one company, which does pretty well in terms of their financial metrics, which is Zoom. And what I look for as well in terms of the unit economics is this LTM, or last 12-month customer acquisition cost payback. So how quickly is the customer recouping its sales and marketing expense? CrowdStrike is able to do this within 17.8 months, 18 months, whatever it may be, which is actually better than the industry average, so that they are efficiently recapturing the dollars that they're spending to gain these customers. And then lastly, this was an interesting stat that I saw on either the last earnings call or 2 earnings calls ago. They generate almost $4 of annual recurring revenue for every dollar spent on customer acquisition. That's remarkable. Let's go on to the efficient and frictionless go-to-market strategy. So first they can land smaller and medium-sized business customers by offering a free demo trial, it's very easy to set up. These customers can just simply go onto the website, download whatever the application may be onto their endpoints, and then from there, they can start using the service for 15 days. And what I love about their pricing model is that it's modular. So I mentioned that they can land with one module, and then every module after that is just margin accretive. And they've mentioned that they've started landing bigger, which means more modules, which can lower your dollar-based net retention over the long run. But at the same time, that's going to just hasten or quicken your payback period. So by having modular pricing, they can capitalize on their innovation and the desire of companies to grow within their ecosystem at a rapid pace. And that's all represented and can be seen by their dollar-based net retention, which I believe now it's 11 straight quarters they've had over 120%. It was 124% in the last quarter, which just shows that their customers are continuing to just buy more and more modules after they land with the company. And then one really interesting feature, Amazon's obviously a behemoth in the market space. And CrowdStrike now can be found on Amazon's marketplace, and they've seen a lot of adoption from that. So it's another kind of sticky and efficient go-to-market type of strategy for the company. Rapid revenue growth is one of the highest growing companies out there. They've been growing at over 80% top line for at least the past 2 years. I think there was only one quarter that they were below 80%, and it was 79%. And so the company continues to execute on the top line. They had $791 million of ARR last quarter, which was, I believe, was it 90 or 87% growth year over year. And it was the first quarter they added over $100 million of ARR, net new ARR, which was very impressive. High quality management team. George Kurtz, this was the second company he founded. The first one was called Foundstone, which was actually bought by McAfee, which he was then the CTO there for quite a while. So he has a lot of experience. He's very smart. You listen to him on the conference calls. He knows what's happening in the industry. And he's shown his ability to execute on this company by not only taking it public, but also by continuing to improve its metrics. Pricing power, it's a little bit harder to really understand how they're pricing within a customer base and how effective they are, but they have been able to raise their prices without losing any customers, and their cash gross margins continue to expand, which is what I want to see. Next is the recurring revenue base. As I mentioned, they're a modular based pricing model. They usually have a year subscription for these customers, but it can range anywhere usually from 1 to 3 years. And once again, we see in the dollar-based net retention that it's above 120%. So that revenue just keeps coming in, which is just gross margin accretive. Next is the sticky solution. So I mentioned the network effects, which to me is the biggest thing. I think that every company that joins a platform is going to be hooked immediately. They're going to see the benefits of having a better security solution, and there's going to be no reason for them to move on. Innovation, they started off as just an EDR in 2013, 2014. In 2017, they developed the Falcon Cloud platform, which was really their entry into the endpoint protection platform market. And they continue to develop more and more modules. They're at 11 now, and they have a steady pipeline coming down the pike as well. In terms of the industry, the current cybersecurity market is, I think it's 170 billion is the total TAM right now, but it's expected to grow to about 270 by 2023 or 2025, around there. So there's a massive runway for the company. And then if you look at exactly what CrowdStrike's target market is, it's currently about 29 billion, should be 31 billion in a few years, and that's growing at about 9% CAGR. So there's a lot of room there for the company to grow just within the market itself, aside from what it's doing in terms of disrupting the industry and taking market share from legacy competitors. It being the top 1 or 2 companies in the industry, I view CrowdStrike, Okta, and Zscaler as really the predominant names in the cybersecurity market. And if you look at CrowdStrike's competitors, Usually it was Symantec, which was acquired by Broadcom. But when that happened, it seemed they really left a lot of customers kind of hanging. And those customers have been flocking to CrowdStrike. So they're actively taking market share from Symantec, from McAfee, and then from, Micro Focus is another one, from different legacy providers that can no longer really suit the needs of the modern company, and with an ever evolving base of attackers that are finding new and innovative ways to break into these companies' networks. Next, I think it's the rapidly improving metrics. In my report, you can see a nice little chart that I put out there, and it just shows unbelievable revenue growth consistently above 85%. Their quarter over quarter customer gains are anywhere from 30% to 20%, which is just simply remarkable that it's continuing to nearly double every year. Their adjusted operating margins and free cash flow margins continue to expand as well. So it's doing all the things that I want to see in terms of achieving profitability. Their last 12-month free cash flow margin was 28%. In the most recent quarter was 18%. That difference is just timing of different working capital items, since deferred revenue makes up such a large portion of current liabilities. So what I want to focus on next is the customer diversification. They used to have some channel partners that were actually more than 10% of AR, and they had a customer that was, I think, more than 20% of AR. In the most recent quarter, though, they now have no companies that represent more than 10% of revenue, which has now eliminated a lot of the credit risk that I look for. They have 91% year-over-year customer growth, as I mentioned. 49 out of the top Fortune 100 companies. I think it's 40 out of the top global 100 companies. Their customers, as of the most recent quarter, they won Zoom's business. They also serve Goldman Sachs, Credit Suisse, some other major companies, I think Sony as well. So a lot of great customers in their customer base. Their balance sheet, they have a ton of cash and no debt. They have about $1.1 billion of cash, which can almost cover their current liabilities twofold. So the company is very well positioned from a balance sheet perspective. They're an asset-light compounder, so they really don't need to invest in CapEx. I think maybe it's, I don't even know what the CapEx amount is. It's very de minimis. Maybe it was 30 million a year, something very small the company can easily cover. And then lastly, what is a customer's view of the company? They had a 71 net promoter score last time that I looked a few days ago, which I don't think has changed since then. And I'm constantly reading about how customers are just raving about the company. So if I was to wrap up, my affinity for CrowdStrike and a few different things, it's why are they excelling? Customers have suffered massive attacks in the past. And it's becoming more and more of an issue in this modern paradigm where the economy is becoming digitized. So they need a superior solution, which CrowdStrike has. Incumbents are losing market share to CrowdStrike, which as of 2019, I believe, had 6% market share in endpoint protection versus, I think it was 2.9% in 2018. So they're rapidly expanding market share. The work from home paradigm makes it even more important for these companies to have a solution like CrowdStrike. And then it's simple and easy to use. And at the end of the day, customers are going to need something that they can easily onboard with and easily use to make sure that they're not wasting time, that they're efficient with the rest of their business.
This was an excellent rundown of CrowdStrike. I am a happy shareholder of this company since a couple of years now. And yeah, they have been executing very well, I must say. So my next question to you would be, you have invested in CrowdStrike. When do you kind of decide to add? And when do you say, okay, I would want to sell this or trim the position in a company like CrowdStrike?
Sure, it's a great question. It's something I'm still learning. So for everyone that's watching, just for full disclosure, I have a pretty good background and I think I can analyze these companies very well. The skill sets that I'm still developing are my portfolio management and I guess you would call it trading skill sets. So this is also constantly evolving along with my framework. what I've adopted, and I've tried a few different things, is the can slim methodology, which is made famous by Bill O'Neill. So as part of that framework, I use a pyramiding structure to build a position. So what I'll do is once I find a company I want to invest in and that has an attractive reward to risk entry point based off of the technicals, I'll start with about a 50% position of what I want to eventually build into. And then once I see the company is being successful in terms of its stock price appreciating, I'll start adding. So about 2% over my initial entry point, I will add my next 25%. And then 2% above that, I will have a full position in the name. So it's a little bit easier for me to build into a position in terms of my framework because it's very rules based. There's no emotion involved. And I find that's easier for me because as investors, we're very emotional, and experiencing especially the volatility recently, having rules in place can prevent you from making critical mistakes. So there are a lot of opportunities out there, a lot of great opportunities. If a stock is currently overextended that I want to invest in, I'll wait. I can be patient, and patience is something that I think pays off in the long run. In terms of selling, there are two different ways that you could sell a stock. It could be offensive or defensive. You don't want to be defensive because it means the name's probably going against you. Offensive is what I think we all look to do. You want to capture, you want to realize gains. And the way that I think about my defensive sell rules is that if I have a 5% loss in the name, and it can be anywhere from 8%, which is what I think O'Neill originally recommended. I do 5%. I know people that have 3% loss rules. But if a name goes down 5% for me on an unrealized basis, I have to cut that loss. And it goes back to what I talked about earlier, which was I want to minimize my left tail so that I can have a positive skew in my returns and I can have a high slugging percentage. Now, when a company comes back, right? So say I sell, it goes down further, then it comes back. If I still have conviction in the name, I'll actually go back into it with more size to make sure that I'm psychologically invested in the name. Now, in terms of offensive selling rules, this can also really depend. Usually, if you look empirically over the 100 past years or so, what you'll see is that the leaders, they basically go 20 to 25% appreciation for the most part. Now, there are some crazy winners out there. 20 to 25% before having either a pullback and building a new base or really retracing completely. So around those levels, I'll take some profits and I'll wait to see what the stock does. And if it builds another base and I can look to get into the stock with more shares at another attractive entry point, then I will do so. Now, there are some exceptions. If it runs up quickly and it gets to 25% within a few weeks, those are usually indicators of multi-baggers, what we, I think on FinTwit called multi-baggers. And so for that, I'll let it run. And I'll wait about 2 months to see exactly what happens with that stock. And if it keeps going up, then great. If it comes back down, I know that at 20 to 25%, I want to make sure I'm taking profits. So that's a high level kind of framework for my buying and selling rules.
Awesome. So the next question that we had for you is, recently there have been a lot of IPOs that have gotten a lot of attention and people have been posting about on FinTwit. So we want to get your thoughts on the recent S1s and if you could tell us one that you're willing to jump in on a day one.
Sure. It was really exciting. It was August 24th, I think, that 5 or 6 different S1s were filed and Twitter blew up. Jameed Ball from Cloud of Judgment, who I recommend everyone following. I'm sure he was frantically trying to get out his newsletters to cover these names. And so some of those names, right, were Sumo Logic, which is kind of like a Datadog competitor. JFrog, which is really doing interesting things on the developer side, which is really allowing them to push software updates and new apps to market quicker. Asana, which is a work management type platform. Unity, which is a gaming type of platform where you can build games on. And then the last one, which I'll focus on, and which I mentioned that I released a newsletter on Friday, is Snowflake. Snowflake I was first introduced to when I was doing my research for Alteryx. But since then, I had the fortunate experience of really diving into the name and seeing some just eye-popping numbers. Now, before diving in, this is also part of my framework in terms of IPOs at a high level. I never invest on day one because if you look, once again, empirically at stocks that have IPO'd, none of them go straight up. Only one has, actually, and that was Google. Pretty decent company. The rest of companies that IPO usually build bases if they're going to be successful over the more medium to intermediate term. And so what does that mean? Is over the first 7, 25 or so, maybe even more trading days, it'll build a base and then break out of that base. So that's what you want to wait for. You don't want to dive in day one because that's really just asking for a lot of volatility and to potentially incur a lot of losses. So that's just, I wanted to state that in terms of my high level framework of the IPOs and also how I'm thinking about Snowflake. I'm not going to be day one buyer. I'm going to wait for it to build a base and be patient so that I can make sure that it's a high reward to risk entry point once I do get it. So, what is Snowflake, right? Snowflake is what they call a data warehouse as a service company. So you can think about it as like a data cloud. They offer a single integrated solution, which is their cloud platform, which provides users with a database to store, compute, and query, and then have cloud services on top of that as well. So they provide instant, secure, and governed access across an entire network of data, and they allow companies to actually share data through their data exchange, which, once again, I'm going to talk about it, network effects. The more customers that it gets onto the platform, the more data that it has on the platform, and the more that customers can share the data, which has more value to each customer and is a positive flywheel effect. So what does this all mean? Right? In a world where data is just proliferating, and I have a statistic that I was thinking about that I'll mention a little bit later on going through the framework, but there's a massive proliferation of data that's occurring. It's really happening with the IoT, Internet of Things, 5G rolling out. And so customers today, they need to be able to see their data in real time and create actionable insights off of that data. Snowflake allows that. The end goal of Snowflake is that you can load data via either ETL, extract, transform, load, or ELT. Either way, Snowflake can ingest all of your data. They can organize it, either semi-structured or structured data, and then you can compute and query off of a data set. Now, I'll get into what's unique about Snowflake in a little bit, but you can do that and then create actionable insights off of it. So now let's dive into the framework side of Snowflake, right? So the first thing that we're going to talk about is the competitive advantage. What's their moat? I mentioned it. It's the network effects. It's the data exchange. The ability to do that and really hook in customers and then build their platform accordingly through the flywheel is very enticing. Now, I think about their three major competitors as Google, Amazon, and Microsoft, the three major cloud providers. But the difference between the four of them is that Snowflake is multi-cloud. It's actually supported by each of those different public cloud providers. So a customer can choose which provider it wants to use for different parts of his business. Whereas if you are with one of the cloud providers, you're stuck. You can't go anywhere else. That's a huge advantage that Snowflake has. Superior product. Now, just anecdotally, I read a lot of the customer reviews that switch from one of the three major cloud providers to Snowflake. And the feedback that I see consistently is that Snowflake has better performance and better cost. Now, usually you can't get both of those things, but somehow Snowflake's managed to do that, which is truly remarkable. And they've started focusing on these large enterprise customers, especially since Frank Slootman took over as CEO. And they've been just executing on that strategy very efficiently. They've grown that customer base by 155% year over year, which is defined as customers that contribute more than $1 million of revenue every year. So obviously these customers are loving the product and I'll touch on this at the end, but their 71 net promoter score indicates that customers love the product and they're recommending it as well, or at least they're willing to. Excellent or improving unit economics. I talked about the rule of 40, which with CrowdStrike, Snowflake has 109% rule of 40. Now, if you break that apart, it's 137% last 12-month revenue growth, which is simply astounding. And they have negative free cash flow margins of 28%. Now, that's obviously going to be a concern for me, but that's been improving over time, which is, once again, what I mentioned I want to see. Their gross margins are also improving, which is going to continue to happen with scale. It was 62% in the last quarter, which is a massive improvement of about 900 basis points over 53% a year ago. So they're continuing to do a better job on the gross margin front. And then what's fascinating is that they have one of the highest cost structures for sales and marketing in terms of percentage of revenue that I've seen in a while. It was over 100% a year ago. It dropped down to 71% in this past quarter. So you can see it's a huge drag on margins in terms of EBIT margin or cash flow margins. But yet they only have a 21.8 month CAC payback, which means that they're really getting a lot of that expenditure back pretty quickly within the first 2 years of a customer being onboarded, which is impressive. So they're doing a great job of improving their unit economics. Their efficient and frictionless go-to-market and land and expand strategy. They have a free trial and demo offering, which can get their small and medium-sized business customers at least trying the product pretty quickly. And we've seen that they're successfully landing by their customer growth and then expanding by their dollar-based net retention. I giggle because their last quarter dollar-based net retention was the lowest that they've had in the past 2 years, which doesn't sound good. But when I tell you that it was 158%, that's actually almost ridiculous. I think the only customer, or the only company rather, that has a higher dollar-based net retention is Zoom, once again, which is a pretty good company to be in. And the company states as well in their S1 that their customers, almost to a T, every single one, they do expand their usage from the start to the end of that first year contract almost every time, which is indicative in the dollar-based net retention numbers. I'm not sure if I'm going to be able to talk about the pricing model too much, so I'll quickly mention that it's usage-based, which I'm a huge fan of because I think that it allows customers to get a direct ROI on their purchases and on their investments. Rapid revenue growth. This is, once again, unbelievable. You know, they're over doubling their revenue every year. They had 133% CAGR over the past 2 years, 137% last 12 months. And I think it was 121% over the last quarter. So they're consistently growing their top line really faster than almost anybody aside from, once again, Zoom. And what I do like to see is that if you look at their bifurcation between product revenue and professional services and the margins from those two lines, obviously product has a lot higher gross margins, and they had about 94% of their total revenue comes from product. Now, I think that's going to continue to gradually shift towards professional services as they get more and more customers onto the platform. But I do like to see that over 90% of revenue is recurring and with a higher gross margin business. High quality management team. Now, it was founded by two guys that used to be data architects at Oracle. They're still both on the management team, but they brought in Frank Slootman about a year ago, a little bit over a year ago maybe, to run the company. Frank is from ServiceNow. And while he was a CEO at ServiceNow over 6 years, he grew their revenue from either 75 or 100 million to 1.4 billion in 6 years. That's a 55% CAGR, which is just remarkable. And you've already seen his impact on the business through their unit economics, their improving margins. And I'm just highly confident that they have the right guy to lead the ship, especially as they go public and into the future. What I love about the company too, and digging through the S1, I saw that management's still going to maintain 30% of the outstanding stock once the company goes public after the offering. So they're going to have skin in the game, which I mentioned is something I look for. Next is pricing power. It's really too early to tell. They did mention in the S1 that they had a 12% increase in their capacity pricing, which was a result of less discounting. So to me, it seems like customers don't need the discounting as much for the company to win the business. So that's indicative of, some pricing power, but I think that's really to be determined. Recurring revenue base, I talked about it. They have over 150% dollar-based net retention over the past 2 years, and I'm sure going back even further, which is beyond impressive. So once again, that's just margin accretive for them. The sticky solution, through their data exchange, it's the network effects. A company that's going to join the Snowflake platform is going to be able to benefit from all the data generated by all the customers on the platform, which doesn't have a value. You know, when I talk about TAM, there's no value to the data exchange yet. It's very intangible, but customers do love it, which is why they continue to go to Snowflake and then expand within Snowflake. Innovation, you know, the cloud data platform is disrupting the data warehouse space. You know, you used to have these legacy on-prem providers that, you know, they couldn't scale capacity to the needs of their customers. They had storage and compute kind of in one layer. So, you know, once you were ingesting the data, you couldn't at the same time be running any queries off of it. Snowflake uses a multi-cluster architecture, which allows users to run different queries off of the same data set while maintaining data integrity, which is something you just couldn't do before. So they're doing a lot of things that really add value to customers and increase business efficiencies, which is what, at the end of the day, these new modern organizations need with you know, data proliferation. Next is the TAM and the large and expanding TAM. So their TAM, they estimate to be about $84 billion, you know, which is growing at about 14.5%, 15% CAGR. The data warehouse as a service market itself is a little bit smaller. I think it's about 2 billion or so right now, but that's expected to grow rapidly by 29% CAGR over the next 10 years to eventually be, I think it was 29 billion by 2030. And then additionally, kind of at a high level for all the SaaS space, you know, only 20% of IT budgets are currently spent on the public cloud, which is expected to be 49% by 2025. So there's a massive runway there for customers to start to continually, I should say, invest in cloud service providers, which would be Snowflake. And then according to IDC, there are going to be 175 zettabytes of data by 2025, which is a 27% CAGR from 33 zettabytes just in 2018, I believe it was. And if you think about how the company's pricing model is, which is usage-based, which is all based off of the amount of data that is being used by customers, that is an inherent tailwind to Snowflake's top line. Top one or two customers or companies rather in the industry. You know, as I mentioned, they do compete with the three big cloud providers. So a risk is, you know, these cloud providers could really turn their attention to trying to build out an even better data warehouse as a solution platform. But what they can't change is the multi-cloud benefit that Snowflake has. So not only, like I mentioned, are customers stating that the performance and cost is better on Snowflake, but they have this inherent competitive advantage that they can provide services across any cloud provider. Rapidly improving metrics. I do encourage everyone to just go read at least the metrics part of my report because it's truly astounding. What I'll focus on right now, though, aside from the amazing revenue growth numbers, their dollar-based net retention, all of the customer growth, all these really amazing metrics that they're reporting, I'll focus on their EBIT margins. As I mentioned, once Frank came in to take over the company, they really kind of tightened the belt and improved their cost structure. And so over the past year, they improved their EBIT or their operating margin from negative 158% to just negative 58% or around there. So I'm seeing this path to profitability, which is very encouraging. And once again, you know, their free cash flow, although it was negative over the past 12 months, it's been improving there as well. So I do see a great path to profitability, which is going to be important because I don't want to be diluted, like I mentioned. Customer diversification. They only had one customer that generated more than 10% of revenue. I believe it was Capital One, but they've stated their goal for that to be 0. And I think that they'll be able to pull that off pretty soon because Capital One's you know, contribution to the top line as a percentage of total has decreased from, I think it was 17% a year ago to just 10% now. So they're showing improvement there as well. Additionally, they have I think the second highest of all the top SaaS names, average contract value of $160,000, which just shows a very efficient sales model. And that maybe speaks to exactly why they have a better CAC payback than their sales and marketing expense structure otherwise would indicate. They have over 3,000 customers now, which is over double since a year ago. And they also had a 155% increase in that large enterprise customer base that I mentioned. They had 22 a year ago, and now they have 56. And they're just continuing to win that business, which is highly margin accretive for them. Going to the balance sheet, they only have $130 million currently of cash. I think it's about 450 to 500 if you include the short-term investments, but there's no debt. And so that's a very healthy balance sheet from a very young company. They're only about 6 years old. And then low CapEx funding requirements, once again, they are cloud native. So in terms of continuing capital expenditure requirements, there is none. But the concern there is on the free cash flow and the operating cash flows and the potential need to continue to issue equity to fund these shortfalls. So that's something I'm definitely keeping an eye on. Lastly, the customer's view of the company. As I mentioned, the 71 net promoter score and all of the great reviews. It's exactly why they continue to more than double their customer base every single year and continue to expand within that customer base by over 50% every year. And that's Snowflake in a nutshell.
Yeah, that was an excellent review of Snowflake, and I am probably planning to get into Snowflake pretty soon, because
Yeah.
every boxes of this company is checked. Like I like, can you talk about any other risks apart from like the competition coming from AWS, Azure, and GCP? Like, do you have anything else?
Yeah, so they compete across a couple of different segments, I guess you could say, of the data warehouse space. In terms of the risks for Snowflake itself, they mentioned something along the lines of increased efficiency of their platform, which would mean less usage. I don't know how real that is. Other risks could be like you talk about, the competition. These cloud providers could just allocate more resources to try to create a lighter product or more dynamic product, as well as kind of expand horizontally within the data warehousing space. But they can't change this multi-cloud paradigm. Customers, and you can see it, I don't know the statistics off the top of my head, but customers prefer a multi-cloud approach so that they can have more control over which cloud providers are using for different services based off of which cloud provider is best to fit their needs. I think that margins are a concern for me. 62% is relatively low, but the improving nature and the improving profile that I see quarter over quarter, year after year, that's something that's really encouraging for me. And something I mentioned a few times just going through the company was dilution. I posted something on dilution a few weeks ago, I think, in terms of talking about the potential impact of a return on equity versus EPS growth. And so if a company is not generating cash flow, it can either issue debt, which would impact the cash versus debt side of things, or issue equity, which would dilute shareholders, which just is not something that I want in my companies. In terms of what Snowflake does versus, Azure and their Synapse product, Amazon Redshift, and then GCP's BigQuery, they offer a lot of the same services from what I could at least tell. And now I'm not the tech expert. I really highly recommend everyone go check out Muji's write-up on the space, because he is a guru when it comes to these things. So I didn't really see any really big differences, but what I could tell was in the customer reviews is, for some reason, there is better performance on the Snowflake product, and it's a better cost structure. So until these companies, the major cloud providers, can find a way to lower their cost structure and improve the performance relative to Snowflake, I don't think they're going to be able to catch up. And you can see this effect with the customer growth within these platforms. Now, I'm not going to remember everything off the top of my head, but one of the three, the highest customer growth rate for their data warehouse product was only, I think, 25% year over year. That compares to over 121% for Snowflake. So customers obviously prefer Snowflake over the competitors, and I just don't see that changing.
And the other thing to note is Snowflake is a pure play data warehouse versus the data warehouse services for these clouds are just one part of their business and not just
Exactly.
The only part of their business, right?
Exactly.
So that also kind of makes me optimistic about this company. So moving on to our next question. this is one question where if the markets were to shut down for the next 5 years, which one stock would you be willing to own and why?
Yeah, sure. So it's such a tough question that, there have been variations of this question on Twitter for a while, and I always struggle with it. If I had to take one, it would probably be Shopify. And the reason why I say that is because they are becoming the infrastructure and the backbone of e-commerce for small and medium-sized businesses globally. Big commerce just, went public, and there have been, some good feedback that I've read on that company, but their growth certainly is nowhere near Shopify's. And so, for the viewers that don't know what Shopify is, they're essentially a platform that provides, anyone, any business owner, the ability to create and maintain a full online operation for their retail business. It's essentially a one-stop shop for e-commerce. And what they've stated is their goal is to build a global operating system for retail. And so this reminds me of Mercado Libre, which I did a thread on either a week or two ago, in terms of they're literally building the infrastructure for a certain market. So for Mercado Libre, they're literally building the payments infrastructure, modern payments infrastructure of Latin America. Shopify is building the retail infrastructure for online businesses. And that market is, you can't even quantify that, because every company in the near future is going to have an online presence no matter what. Shopify seems to be the company of choice for every single customer. Now they're vertically integrated and they can scale, right? So they do website design, they do product design, they do performance tracking for these customers, really everything. It's a full end-to-end suite, which is nice because you don't want to have to use different providers for different services for your company. And so customers love that aspect of Shopify. Now I'm going to mention a word or a term that I've used quite frequently, and you're going to notice a theme is network effects. So they have, I think it's over 2,500 different applications through their app store. And now partners are starting to work with each other to build different applications together, all with the purpose of creating a more seamless and efficient process for these companies to sell their products to customers. And so their ecosystem of developers, of startups and ad agencies creates this positive flywheel effect that just builds and grows with each customer that goes onto the platform. And what I like is that 100% of businesses, as I mentioned, are going to need this e-commerce solution. So the TAM is barely tapped into. They have a really underpenetrated market that will just continue to expand. What I love is that their business model is really aligned with customers. So, they charge a percentage of GMV, gross merchandise volume. So they benefit and they grow when their customers grow. So of course they're going to align and build a product and a platform that is exactly what customers want and will allow them to continue to grow within those customers. And what a evolving paradigm is in this e-commerce space is this direct to consumer concept. It's a turnkey solution, as I mentioned, right? And so if you think about Google and Facebook as being critical to anyone that wants to have an online advertising presence, Shopify is that, but for retail. That's powerful. That's very powerful. And so, just to wrap this up, lastly, just talking about the industry tailwinds, the rising e-commerce tailwinds of the SMB, small to medium-sized business merchants is just going to continue to grow. I think that the percentage of sales of this cohort was only 1.7%, of total sales in 2019, and that's going to grow to at least 10% by 2030. That is a huge runway, and still on top by 2030. So, you're talking about just years and years and decades of this company growing and compounding. A great stat that I saw the other day was that, there are 1.8 billion global digital buyers in 2018. And so that's going to continue to grow as well. And then lastly, they're also developing this new hardware offering. So they're not only going to dominate on the online market, but they're also expanding into physical presences for whatever's left after this coronavirus. So just a lot of tailwinds for Shopify. I love the large and expanding TAM. I love the product. I love the network effects. And Toby Lutke is one of the best leaders out there. So it would probably be Shopify if I had to choose.
Yep, and I think we're all Shopify shareholders here, so I don't think you'll get any disagreement from us. And just a quick anecdote is, I over Labor Day weekend I started making a Shopify store,
How's your
and
experience?
yeah, it was so easy, but and the thing that stuck out in my mind, everything that you said resonates with me, but the thing that opened my eyes is they have vendors, applications that you can download that serve print on demand.
Yep.
So you could literally have just an idea of a company, an idea for products and designs, and you can download these applications, and you won't have to hold any inventory. You won't have to manufacture any products. All you have to do is worry about the branding of your website, and the designs. Just having ideas. Do it all from your computer and never actually have to physically touch anything. Which is incredible. What they've built there is insanely hard to do, and so I think the moat is really strong there, and they're unlocking value that wasn't there previously,
Exactly.
in my opinion. So that's in addition to all the businesses that already exist and just need an online presence.
Yeah, no, I mean they're unbelievable, and your experience, I think, is just par for the course with everybody. It's a super easy process. And I think that, as you mentioned, that was about the third highest rated app on their platform. And there are just so many like it too. So, all they're focused on is making the process easier for customers and allowing them to sell their products even easier. So it's truly remarkable what they're doing. And it's something that I think it met a need in the market that maybe people didn't think about, and now that they are aware of the product, it's just going to keep taking off.
So that leads us to our next question. We wanted to know if you had any book recommendations. So Deval and I have been swapping book ideas lately. If you could talk about at least one key takeaway from any book that you're reading and maybe why you're recommending that book, that'd be awesome.
Sure. Yeah, no, sure. So first, I need to be involved in this sharing of book ideas process because I'm an avid reader. So as part of my process every day, I'm just reading, consuming information, and I love it. I love learning. It's one of my whys. If you're thinking about Simon Sinek, what's your why? One of mine is intellectual curiosity and learning. So I was trying to think about just one book, but I think there are two, and I'll be really quick. And actually, I don't know if everyone can see, but I think they're both behind me here somewhere. One is Thinking Fast and Slow. And now you wouldn't think about it. It's by Daniel Kahneman, who is basically the father of behavioral economics, along with Amos Tversky. I didn't really dive into behavioral economics or cognitive biases before I read this book. So I was just almost every page I was like, oh my god. It's all about cognitive biases and how humans think. What are our pitfalls? How do our certain cognitive biases affect our decision making? And why does it make no sense? And so really the translation there into the public markets is that every individual, every person, me included, we all have cognitive biases. And you have to be aware of that. Now there are different thoughts out there in terms of the madness of crowds, wisdom of crowds. And the thought is that, all of our individual biases may cancel out at a market level. But in terms of just understanding people and how they think, there was nothing more valuable to me than reading Thinking Fast and Slow. And it's a dense book, but it was one of my favorite reads. And I just read it, I think, maybe March or April of this year, during the pandemic. And then secondly, and I've mentioned CAN/SLIM and certain different aspects of my framework and process, is a Bill O'Neill feature and framework. His book, How to Make Money in Stocks, is probably one of the most influential that I've read in terms of my investing process. And so, I could just basically talk about what CAN/SLIM is. It's a framework that wants to look at in terms of the companies that you're going to invest in. You want to have C is the current annual and sales growth. Usually I'm looking for above 40%. That can change for every individual investor. I want to see annual earnings growth year over year consistently and hopefully accelerating. The N is, new products or new management, new innovations, anything that it may be, and then also new highs. So it's really the momentum effect, right? The companies that have done the best over the past 12 months tend to do the best in the next 12 months. The S is related to supply and demand. So the shares outstanding, and you want to look at big volume, right? So volume is something that can really tell you what institutions are doing in terms of the buying and selling of stocks. And the institutions are really the ones that move markets. Unlike what some people may think with these Robinhood traders, it's the institutions that you want to follow. And so volume tells that story. Next is going to be a leader or laggard, right? The L. I want to invest in the leaders, like I mentioned, the top 1 or 2 names in the industry and the top, 1 or 2 industries in the market. And then next will be institutional sponsorship. I mentioned, on the volume side, I do, and everyone will see in my newsletters for the public companies, I mentioned how many funds or institutions own the stock and what percentage of the float that is. It's important to know because these institutions, like I mentioned, are the ones that are driving stock prices. So the more that are buying, the higher the stock has room to go. And then lastly is market direction. So if anyone's read, and this is another great book, the Jesse Livermore book, Reminiscences of a Stock Operator, the old turkey, he'd always say, it's a bull market, and the lesson there is that when we're in a bull market, stocks go up. Not always stocks go up, not the day trader, but when we are in a bull market, stocks tend to go up. And so you don't want to, for instance, short a bull market. But once again, the market direction will have a significant impact on how stocks move. If you just think about beta, right? And so, what you want to do is try to get some low beta names in your portfolio. But a lot of, names are very levered to the market's movements. So you want to make sure that the market is in an uptrend. And so that's really kind of what I've learned from the How to Make Money in Stocks book. Highly recommend it for everybody. I've read it only once. I need to probably read it about 10 more times to really capture it all. So I highly recommend everyone go read both those books as soon as you can.
That's excellent advice. And I have had few conversations with few people on Twitter, and they were talking about book club. And I think we should definitely get something started on those lines.
Yeah, book club would be great. More than happy to get joined.
So we are coming to the end of the podcast, and I just wanted to see if you have any final thoughts and any advice for new investors tuning in our podcast.
Yeah, definitely. So as I mentioned, I'm relatively new to the portfolio management side. So I'm not going to really dig too deeply into into that kind of feedback. But I do want to say that investing is very hard. It's incredibly hard. Maybe it may seem easy for, some of the more newer investors out there since we've had such an amazing stock run up since March, but it's very hard. So keep at it, keep learning, look at your mistakes as opportunities to learn and grow further. I just think about everything in life is all about mindset. And so if I make a mistake in a trade or a name or investment, whatever it may be, I want to make sure that I'm doing a post-mortem, in addition to my pre-mortem, a post-mortem to really understand where did I go wrong, what should I do differently next time, and what lessons have I learned. I did do a newsletter on my portfolio update, I think it was last week, and I really focused on the lessons that I've learned because I think it's important for different investors to maybe learn from my own mistakes so they don't make the same ones. I mentioned this earlier, if you don't have the time to do the requisite research on individual companies, just invest in indexes. Over time, the stock market has gone up. I think it's like 70% of the years, and the average gain for those up years is something like 19+%. The down years is only 12%. So over time, you'll do fine by just investing in ETFs. And I've just seen so many investors get burned by not truly understanding their companies and trying to invest in individual names. Don't do it. If you have the time, great. If not, I think that passive funds are the way to go. I have my own process and framework. You all were able to learn from it today, but I highly recommend that each of you develop your own process and your own framework. What works best for you, how you view the world, how you view the market. No certain process is right. It's really all about what works best for you and sticking to it and then continuing to develop it and expand it as you grow and learn more. Um, Mindset is everything, like I said. We've all had our challenges, in life. I've certainly had plenty of my own, especially before I really started getting more focused on public markets investing for my career. And so what I've learned is that, having that positive mindset, just that willpower, that desire to succeed, no one can stop you from achieving any of your goals. I truly fundamentally believe that. Breaking into the hedge fund space it's not easy. It's really hard. And I'm trying to do that. But I refuse to let anybody tell me that I can't do it. And so I'm just going to keep working as hard as I possibly can and doing all the right things to get there, to achieve my goals and my dreams. And everyone can do the same thing. Nothing stopping you. I think lastly, it's all about comfort, in my opinion. There are people that go through life and, they can do the comfortable thing, and there's nothing wrong with this, right? They have a nice 9-to-5 job, they have a nice family, a nice little house in the suburbs, and, they're comfortable and happy, and that's great. But for me, that's not who I am. I don't think that anything in this world has ever been achieved in a state of comfort. I think you have to be comfortable in discomfort. And so I'm constantly looking for ways to break out of my comfort zone, to be uncomfortable, and to become a better person, become a better investor from that. So I encourage you, if you want to achieve greatness or do something that you really love to do and it's not comfortable, step outside that comfort zone and go for it. Because the worst thing that can happen is that you don't succeed as fast as you want to, because you will succeed eventually.
That's excellent advice, and I wish I had that 10 years back.
Same here.
All right. So what we usually do in our podcast is we give shout outs to Twitter accounts. And for this episode, we are going to give out like the shout outs to Julie Young. The Twitter handle is @JulieY4. And the reason why I kind of recommend this account is Julie writes about insane companies that no one talks about. And she has written about 2 companies so far in our Substack newsletter, which are the C Limited and MGA Entertainment. And both of them were like phenomenal write-ups on those companies. And also I have seen is like she live tweets about all the companies' earnings report. And like when it was the C Limited's earning report, she kind of woke up at 4 o'clock in the morning to live tweet about it. And that was awesome. And she has also done a lot more like Fastly, Cloudflare, Mercado Libre. And she is definitely a must follow in my opinion. Highly recommended. julieyoung.substack.com is her newsletter. So feel free to subscribe there and follow on like Julie Y4.
And my recommendation is Software Stack Investing. That's @Stack Investing. And I feel like most people probably know about Software Stack Investing already, but if you don't know, you really should follow Peter Ofringa, who's the main author behind Software Stack Investing. Peter, who I mentioned was the main author, he's got a ton of experience as CTO and VP of engineering at several tech companies in the past. And I don't really know why his content is free, to be honest, because I would gladly pay for it if it wasn't free. But I guess he's independently wealthy and is bored and just really likes, I don't know. It's just it's a crazy resource that everyone should, take advantage of and read up on. Every time I read through one of his write-ups on a new company, when I think it's about to be done, it's like I'm only 65% of the way through or something. He goes into incredible detail on the technical aspects of the moats of a particular company, the competitive advantages of the company. as well as the overall business strategy. And he's also incredibly transparent about his portfolio, which is also awesome. You could tell like what he's got skin in the game on. So yeah, you got to follow at Stack Investing.
I have to concur on that, and it is like a phenomenal resource for anybody who wants to know about the deep dives on the companies that he kind of writes about.
Yeah, and if you guys don't mind, I'd love to comment on both. You know,
Yes.
Julie and Peter are, I mean, excellent, right? So I just started getting involved in FinTwit a few months ago, really, I think in Q3. And, you know, they've been two people that I've followed that I've learned a lot from. And, you know, obviously there are a lot more out there as well. But, you know, what is interesting to me is that, you know, we all can cover different companies or even the same companies. And it's really amazing to see the different perspectives that each of us have in our own methodologies and our own ways of approaching these analyses. And I think that, you know, our viewers, readers, whatever it may be, can each take away something different from each report. And so, you know, I look up to, you know, these different accounts and I learn a lot from them. And I'm sure they do the same for me as well. And so it's been a lot of fun just getting to know these, not only Julie and Peter, but also everyone else, like both of you, on Twitter over the past couple of months and seeing how just smart everyone is in all these different perspectives.
Yeah, Twitter's a game changer for retail investors for sure.
Yeah.
All right. Well, that's our show. If you would like to follow Chris Seifel on Twitter, it's at Seifel Capital, and you can follow his Substack at seifelcapital.substack.com. You can follow me at Kermit Capital, and you can follow Deval at Deval_Kotecha. Until next time, thanks for listening, and hope you all have a wonderful rest of your day.